So, how do we actually go about estimating this model? Well, we run a regression. So remember, we take the excess returns to HP as our dependent variable. We take the excess returns to the S&P 500 index as our independent variable. And if we do this in Excel, our results will look something like this. So what does this actually then mean? First of all, did we get a good model? And if we did, what is the security characteristic line of HP? In other words, what are its alpha and beta with respect to the market portfolio as proxied by the S&P 500? Well, a few things to look at here. First of all, what's sort of our bottom line quality of fit? That's described by the R-square. How much of the variation in HP returns do we explain? If we look at the market portfolio in terms of the S&P 500 index, well, we see it explains about 52% of the variation in HP's returns, which is, good but not great. There's still a lot more that seems to be going on with HP, but that could be because HP has just higher firm-specific error, firm-specific risk. But at least this does provide encouraging evidence in the sense that 52% of the variation in HP's returns is explained by the S&P 500 portfolio as the market proxy, a meaningful portion, which means that this is a credible macroeconomic factor for explaining the variation in HP's returns, in other words, HP's risk. Now, what is sort of the exposure of S&P 500 of HP to the macro factor proxy, the S&P 500? Well, that's the model's coefficient. The slope coefficient on the S&P 500 independent variable is essentially our single index beta, and in our case we see that it is 2.03. And the intercept in the regression model is our single index alpha, and we see that's 0.0086. Now, how much confidence should we have in these alpha and beta? Well, the good news is that we can actually answer that by looking at the statistical tests of significance, which, remember, requires comparing the coefficients to the standard errors of the coefficients in the model. And if we compute a t-statistic as the ratio of the coefficient over its standard error, and we consult a table of critical t-values, we can actually see, for example, that the critical t-statistic for a 5% p-value, in other words, for being 95% certain that our estimate is different from 0, for a two-tailed test, which we probably want because beta can be positive or negative technically, with about 60 degrees of freedom, technically we have 59 degrees of freedom, is in the t-stat table 2.0. So we can use that as sort of the ballpark figure. And more broadly, a t-value above 2 is generally going to be highly likely to be statistically significant. But again, you can look at the precise values in a t-stat table. But Excel will actually compute the p-values, in other words, 1 minus the certainty threshold that we might seek for us. So there's no real need for us to consult a t-stat table. We can see that we can be more than 99.99% certain that our estimate of beta is statistically significant, significantly different from 0. So it is not 0, it's likely to be the number that we've actually estimated here, because the p-value is below 0.0001. Whereas for our alpha, we actually see that the p-value is 0.38. In other words, at best, we could be what, 62% certain that this estimate is different from 0, which is not usually considered a significant level of certainty. And if so, then the statistical hypothesis test suggests that really the intercept coefficient, the alpha, is not statistically significant from 0. We could treat it as 0 effectively. And these two taken together do suggest then that the S&P 500 is actually a good proxy for the market portfolio, because HP's exposure to it is statistically significant, and it looks like HP is actually not providing any abnormal performance relative to this market portfolio proxy, because the alpha is not statistically significant from 0. Now, the other thing that we can see is the correlation with HP. That's the first term in that table, the multiple row. So that means that there's a high degree of correlation between the risk asset that we're curious about and our market portfolio proxy, which is further encouraging. And as we saw in the R-square, the market explains about 52% of the variation in HP's returns, which, doesn't necessarily mean that this is a bad model. It could just be that HP has a high degree of firm-specific error to it. Now, the alpha, if we annualized it, this is using monthly data. If we annualized it, we would get about 10% per year, but really we wouldn't, because it's not statistically significant. And finally, we actually not only know that the beta is 2.03 with 95% statistical significance, but we can actually construct, using the standard error, a confidence interval about it. And in this case, our confidence interval would be 1.43 to 2.53, and that can, again, be based on those critical t-values. So what is then the optimal risky portfolio with the index model? Now that we know what the index model is, how we can create a proxy for the macroeconomic index factor, how we can actually estimate each individual asset's exposure to that risk factor, well, then how do we actually go about constructing an optimal portfolio from these exposures? And I suppose we should ask ourselves, how do we actually do compared to what we might get using the portfolio theory variance-covariance Markowitz approach? Well, first we need to figure out what our portfolio assets are. And we can see that generally we could expect portfolio assets to be, some portfolio assets will be more risky, some will be less risky. So for example, here is a plot of the S&P 500 return with HP and Dell, and you can see that particularly HP is actually highly volatile, which might explain why our R-square was fairly low. And if we look at a plot of two different risky assets next to the S&P 500 returns, Walmart and Target, we can see that those are less volatile. And if we look at a plot of two more risky assets, BP and Shell, we can see that those are even less volatile. And it seems like, for example, BP and Shell follow the S&P 500 more tightly, whereas HP and Dell seem to deviate significantly from it, consistent with higher firm-specific error. But it could also simply be that their exposures to the S&P 500 are greater, so that when the S&P 500 is up, generally, HP and Dell are both up, and when the S&P 500 is down, generally they are both down, though not necessarily. So this sort of suggests that we will be able to capture both the sort of systematic and firm-specific errors from each portfolio asset using the single index model. So how do we actually go about doing it? Well, the first thing we need to do is actually, of course, define our macro index. So if we're going to use the S&P 500, that means that we need to actually estimate what the risk premium and risk of the market index is going to be. And remember, just as in portfolio theory, we want forward-looking estimates, so do we want those here. But the good news is that really then we just need one set of estimates for simply the market index, the S&P 500 perhaps. We don't need to create forward-looking variance-covariance matrix, a big variance-covariance matrix for all of our risk assets. Now, once we have that, once we have a sense of what the expected risk premium and risk of the single index is going to be going forward, we can relate that to the expected returns and expected risks, both the systematic and firm-specific risks, for each of our portfolio assets, using these sorts of regression models, like the one for HP that we looked at. Remember, we can actually estimate the beta of each firm on the market index. And if we assume that that historical estimate will be borne out in the future, then we can actually get an estimate of our variance, both systematic and firm-specific, from that estimate. So the systematic variance is, of course, remember, going to be the beta square times variance of the market index. And the residual variance we can actually compute by literally taking the errors in this regression model, the residuals, in other words, the differences between the return on each of the risk assets minus the predicted value of the returns of those risk assets from the model. We'll call that Ri hat, and Ri hat is going to be our alpha plus our beta. We can denote those as alpha hat and beta hat because those are the estimates from our regression model, times the return to our market portfolio, the S&P 500. And so that will be our firm-specific error. And once we've produced a time series of those, then we can take their variance, and that can get us an estimate of the firm-specific risk in this firm. And we can do that security by security. And of course, we can also then say that the expected return for each security, before we do any sort of security analysis, just the expected return based on its exposure to the market risk factor, is also going to be effectively this R hat, the alpha that we estimated plus the beta that we estimated times the expected return to the macro index, which we estimated in step 1. Now, if we wanted to go a step above, then we could actually try to estimate sort of a better forecast of the expected returns for each security. So to do this for the S&P 500, what do we need? Well, we need the risk premium that we expect to obtain for the S&P 500. We need to estimate the standard deviation of the S&P 500. For each of the firms in our portfolio, we need their betas and their alphas. And from these expected returns, as they differ, at least in the historical record, from the realized returns that we've observed for each of the n-risk assets. We can actually then compute that residual variance as the difference between what the return actually has been versus what the return from our single index model in terms of alpha and beta would predict. And that residual variance then is going to be our firm-specific risk for that portfolio. So you can see the good news here is that instead of estimating an exponentially growing set of parameters with variance and covariances getting bigger and bigger the more assets that we have, really the number of parameters we need to estimate just grows linearly. If we want to add another asset to our portfolio, we just need to estimate its beta, its alpha, actually get those regression residuals, in other words, the error terms from our model, to estimate the firm-specific risk. And that's all we need to do. We don't need to go through the portfolio theory process of estimating a covariance of this new asset with each of our prior assets. That's sort of the big savings here. And once we have these, then actually estimating the inputs into the portfolio theory model is quite easy. Remember, we want our expected returns, we want our portfolio variance, and we want ideally a Sharpe ratio as the ratio of those two. So how do we get that? Well, the expected return to our portfolio is going to essentially be the alpha of our portfolio plus the systematic expected return, or I guess the expected return from bearing the systematic risk exposure of our portfolio, which is just going to be the expected return to our macro index, to the market, times the beta of our portfolio, just as it is for any risky asset. How do we compute the alpha of our portfolio? Well, we just take the alphas of all of our individual stocks and we weight them by their proportion in the portfolio, because remember, essentially returns are linear, right? So to get the excess return on all of our stocks, we just add up the excess returns on each individual stock. So for alphas, we would do it just like this. And for our exposure to the macro factor, well, essentially the portfolio, the beta of our portfolio is going to be a weighted average, in other words, I guess a weighted sum of the betas of all of our individual portfolio constituents. Some of them are going to have higher betas, some are going to have lower betas, but since their exposures to the risk factor are, again, linear, then all we need to do is really just weight the betas of the individual portfolio constituents by whatever proportion of our portfolio they constitute, consistent with what we learned in portfolio theory, and then add them up. And that is our portfolio beta. And then, of course, the expected return is just our portfolio beta times the expected risk premium to the market portfolio. And combined with the alpha of the portfolio, that all gives us the expected return to the portfolio. So in a way, this part is actually a bit more cumbersome when we do it using the single index model way than if we had done it the portfolio theory way, where we just add up the weights for each asset times the expected returns for each asset. But when we move to the variance of our portfolio, or its standard deviation, now we can actually see how much simpler it is than writing out the, for enough risk assets truly mind-boggling, linear algebra would take to express all of the variance and covariances times each individual portfolio constituents' risks. Instead of doing that in the portfolio theory way, all we really need to do is just say, well, the variance of our portfolio is the square root, or sorry, the standard deviation of the portfolio is the square root of the variance. the variance of the portfolio in single index model world is made up of these two components that we learned: the systematic variance from the index model, in other words, the variance of the market portfolio times the square of the beta of our portfolio's exposure to it, and the variance of the firm-specific component of our portfolio. So how do we get these two? And then if we want the standard deviation, we just take the square root of the variance, or if we don't, we just get the portfolio variance from the sum of these two parts. Well, the good news is actually calculating the portfolio systematic variance is now quite simple. All we literally need to do is just calculate the portfolio beta and square it. And we know what the portfolio beta is. Remember, it's the weighted sum of the individual portfolio asset betas. So we carry this calculation out just as we did in the calculation of the expected returns above. We take the proportion of each of the portfolio assets in the portfolio, multiply the beta of that asset by that proportion, add them all up, that gets us the beta of the portfolio, and all we do is just square that. That is our portfolio beta square. And to get the systematic risk of our portfolio, all we need to do is multiply that portfolio beta square by the variance of the market portfolio that we had forecast already. So instead of forecasting multiple covariances, all we need to do is estimate betas and estimate one variance of the index portfolio. Now what about the firm-specific errors? Well, for this, what we need to do is, remember, we need to get this estimate of firm-specific errors for each of our portfolio constituents as the variance of that asset's residuals from the regression model. That's going to be our estimate of firm-specific error. And if we want the variance, then we need to essentially calculate the sum of the squares of those weights. Because remember, technically what we want is the expected value of the squared deviations from the mean to get a variance. Well, if the expected value of each of the firm-specific components for each of those individual firms in our portfolio, if the expected value of that is 0, then we're really just taking the square of whatever the variance happens to be. That's the distance from the mean being 0. And then all we do is just multiply it by the weight squared. And if we then want the standard deviation, all we need to do is add these up to get the total variance of the portfolio and take the square root. So that is going to be the standard deviation, and again, without the square root, that would have just been the portfolio variance. But this, again, shows just how much simpler the single index model approach is than the portfolio theory variance covariance approach, simply because we don't need to estimate the tremendous variance covariance matrix. All we need is just betas and regression residuals. And finally, then the Sharpe ratio of our portfolio is going to be just the ratio of these two terms that we have now defined: the expected return in the first equation, the standard deviation in the second equation. And if remember, since the regression was run on excess returns, that means that this actually is the expected excess return, so this is already net of the risk-free rate. This is the expected return to the portfolio minus the risk-free rate. And if we divide that by the standard deviation of the portfolio And remember, since we know the risk-free rate, we can actually take that out of the expectation because it's a constant. So we can discard this parenthesis here. That is maybe the more familiar version of the Sharpe ratio. But now that shows us that we can actually define the Sharpe ratio as a function of only of the parameters that we have had to estimate for this single index model. The alphas of each individual security, the betas of each individual security, the variance of the residuals for each of the securities, and the variance of the market portfolio itself and the expected return to the market portfolio itself. And then, of course, we can, since the one thing that we actually have control over are these weights in the portfolio, we can, just as we did in portfolio theory, we can actually then say that we're going to maximize the Sharpe ratio of the portfolio by adjusting the weights for all of the portfolio assets I. So we can still carry out that same optimization. It's just much simpler for us to actually compute and more accurate, potentially, because we don't run into this problem of estimating multiple variables with error. It's potentially more accurate for us to estimate the Sharpe ratio this way, as opposed to the portfolio theory.